Somebody should be arrested for this. Come on, get out of here. Ugh. Can't hear Garrett very well. Then you're using the wrong type of scotch. All right. 301. I hope everybody's having a good day. We're going to dig into lots of stuff. Let's start with the insiders, right? All right. So, what is the market telling us around the current state of momentum? Well, as we said, we're at a positive 5 number. We're going to go through the math behind this, but look at the fact that the insiders aren't buying. Pretty simple. They're not buying. Insider buying is selling in dollar amounts currently at levels we really haven't seen since July. Market continuing to move higher. That's the red line. The blue line you're looking at is the 5-day moving average of insider buying to selling in dollars. Now, I know that some people go, I don't really care much about what the insiders do. I'm going to tell you right now. The insiders have called the bottom of every financial crisis since 2008. This is what they do, right? This is the aggregate of all data. There is a bottle of blue labeled Don at my new house that has not been opened. My cousin bought it for me because he was my real estate agent. Anytime you want to come over and pick it up, you have to physically come here, though. You have to physically come and pick it up. I do not drink brown liquor. I don't like it. I don't feel good about it. Today has been a little bit of a rough patch. I went to the Ravens game last night. I'm usually good before noon, but the day after, oh boy. All right, so we are catching up on our sprint. I went to the gym. I swam 1.5 miles. I got in the sauna. I got in the steam room. And then I came home and I went, oh yeah, I'm 44, aren't I? Okay. So as you could see, these spikes, 5-day moving average, this is the market calling the bottom. You don't have to overthink this because, again, every single major move that you see here in these spikes is insiders calling the bottom because there is a policy shift that accommodates and prints money. This is 666 on the S&P SPY. This is 6667, 1,000% in a decade and a half. It wasn't fundamentals that brought us here, everybody. It was pure money printing. Quantitative easing, more 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 quantitative easing. That's all this is. So just take a step back and recognize that you were trying to keep your head above water. Gold has gone from what, 300 an ounce to 3,700 in the same duration. This is just a measure of capital in, capital out, and capital in has remained strong. And as you will see, every time we see these spikes, it has accommodated these downturns in the market of 10 to 15%. And we just had one recently in April. And they pivoted. The Fed pivoted in March. The Treasury Department moved rebalancing of the debt upward in the scale to the front end of the yield curve. And the market has moved to all-time highs. Somebody said to me today, why is this the best company in the world to own? Why is this the best company to trade? Because fundamentals don't matter. At the top end of the curve, top 10% stocks, 39% of the S&P 500, 1,200 ETFs that carry these types of names like Tesla. It has nothing to do with fundamentals. It has everything to do with the leverage in the system, and the more money that moves through the Treasury Department, moves through the Fed actions, moves through shadow banking. We have added $15 trillion to the global pool of capital in the last year and a half. And people go, how are we at all-time highs? How are these zombie stocks doing as well as they are? Jim Cramer has the audacity to put on Twitter, I really wish that we would move away from all the speculation around gold and zombie stocks. Well, petition, sir, petition your central bank. Petition the Bank of Japan, the Bank of China. When money moves into the system and money expands, equities move to all-time highs. This is not that complicated. I spent a freaking fortune in graduate school 3 times, 4 times actually, to just go, oh, this was a waste of my time because none of my professors were thinking about this in any way. All I did was get a blog post to Michael Howe, read Posner, read Henning, and then relied on all of my insider buying knowledge. That's it. It's like that scene in Good Will Hunting where he's about to fight the guy in the bar and he goes, you spent 200 grand on an education you could have gotten for $1 and a library card and late fees. That's how I feel about it all. And until somebody proves me otherwise, and I challenge them, bring it. Somebody step up. Somebody come and go, Garrett, you're wrong about liquidity and insider buying and momentum. Somebody prove me wrong. Prove me wrong. Show me that I'm incorrect around this. Nobody wants to do that, and nobody has stepped forward for 9 years. So we will continue to trade this until it breaks. And as we can see right now, insiders are tapped out. We are at all-time highs based on that red line, and we move forward. Rick went to Panera only once. The prices are outrageous for what you get. Perfect illustration of your inflation thesis. I agree. This soup is mediocre, which would be a great name for a blog, by the way. This soup is mediocre. Just talk about soup. Mediocre. This is a public company. This is disgraceful. Disappointed. Very disappointed in the soup. Should have spent 10 years in the Army. No. No, thank you. I appreciate it, though. I appreciate your service. I'm not doing that. I will, no. Hard pass. All right, here we go. Trading View. Go to Starbucks. 100%. All right, so we're selling off the end of this day, and we're watching the market bleed off the way that markets bleed off, and that brings us to the good old SPX. And luckily, we are now, look at that. Oof. That's brutal. 4th deviation band move. Not just that. Blew through the 4th deviation. That's a fifth deviation move right there. And not giving us any mercy at all. That's one of these days where you move into the 4th deviation and you set a stop. And we sold off. And let's look at the SPY real quick. We didn't get it, right? Traced along that 3rd deviation move. You would have entered here. You set a stop. You sell off. What we're looking for in the last 50 minutes of this beautiful trading day is a reversion. And we have to be patient. And we have to wait for it. And we're going to watch the SPX. Because do not be shocked by one of two things today. A move to 660 to close the day or a move back to 665. You want to speculate? You want to bet? Going to play some games? Look at the 664 right now. 664 to close the day. That would be your number. That's what you're aiming to look for. But you're looking for some volume to come in the last hour. We're chopping around, consolidating around that 662.30 level. Are you feeling lucky? Typically, what we look for is that move outside that 3rd standard deviation line. We saw it. Look, it legitimately traced the 3rd deviation line. And the second that it moved outside, it bounced. It didn't bounce much. It bounced just enough. It's a lot. It's $1.50, $1.30. You can do a lot with $1.30. So, what we're looking for? Really think we go up? Daniel, I don't know. I don't. I want to keep pointing that out. I have 4 master's degrees. I'm in IQ societies. I have written multiple books. I have many leather-bound books in my house, if you will. And I couldn't tell you where the market's going in the next 10 minutes. I don't pretend to know. I don't do it. What I do is I put myself in a situation to make a calculated trade around it. Now, you can call it a bet if you want, but really at the end of the day, it's about understanding what the market is providing you in the short term. Now, we have that 8-day EMA and that 20-day EMA that I talk about all the time. But if we add some variables, if we add some adjusted EMAs, if we look at the 8-day, for example, and where we're operating down to that 8-minute chart, it's always important to scale back. Don't go to the 1-minute chart on EMA. You're not doing yourself any favor. But now you see that adjusted 8-minute chart times 3, 24-minute chart. Move back 18 cents. We can get back above that 20-day adjusted. 30, 110, 110,000, 110,000. There's your answer. Back in 2008, after the financial crisis, I looked around and I said, shit, what happened? March 2008, I went to Florida. I wrote a romantic comedy that did not go anywhere. Terrible book. It was called Mr. Right in Front of You. It's a piece of shit. I will put it that way. Don would actively make fun of me if he ever read this book. August, my father called me and he said, hey, why don't you get your shit together? So I made a couple of phone calls, got a job with a consulting company that was based in Truckee, California, and I moved back to Chicago. And I moved back to Chicago on September 8th, 2008. 7 days later, because my internet was not installed, I walked to the Washington Library from my house, thinking, I need to check my emails. I don't have the internets. And that date was September 16th, 2008, and that was the day that Lehman Brothers collapsed. Oof. I watched as people exited JP Morgan Chase, Wells Fargo, all of the institutions on State Street in Chicago, carrying their lives in boxes and realizing I had zero clue what the hell had just happened. In March 2009, my company informed me that they were going to be shutting down their consulting arm in July, and I had to figure out what I was going to do. I got into Yale Business School, and I thought about it good and hard. And I thought, I better study the financial crisis first. So I applied to Johns Hopkins in D.C., where they had a new government program built around global security studies, specifically built around 2 concepts. 1, monetary policy, and 2nd, energy security. And that's what I did. And I moved to D.C. I worked in lobbying. I was on K Street for a while. And then once I got done with Harvard, or forgive me, with Yale, no, with Hopkins, good grief, I applied to multiple business schools. I got back into Yale and a couple other places. And I wrote an article where I interviewed Jim Rogers, great guy. Jim Rogers, rodeo cowboy, financial, broke the Bank of England, Druckenmiller guy, George Soros guy, rode across China on his motorcycle. And I talked to him for an hour, and he was working out while I talked to him. It sounded like he was having a heart attack. And then I got him off the record for an hour. And I said, would you, as a Yale alumni, as he was, go back to Wall Street? Because I worked there in 2006, 2008. He said, no, go into agriculture. It was a hell of an argument. And he was talking about how all the farmers were going to be driving Ferraris in the future. I was like, ooh, that sounds good. So I wrote this article, 2011, and it said, he told me to go into agriculture. That's how I started the interview argument. And a week later, I got a phone call from somebody at Purdue University. And they said, we see that you have qualified for Yale and some other pretty good schools. Would you at all be interested in a dual program that we have at Purdue and Indiana? Purdue, you get a master's degree in agricultural economics, and from Indiana, you get an MBA in finance. It's half the price. You don't have to move to New Canaan, Connecticut, which was a blessing. And I said, yeah, I'm in. So that was 2 degrees for half the price, and I did not have to move and go up to Connecticut. And I got to go to Indiana, and I love the state school concept. I love having conversations with Harvard and Yale MBAs where I just go, shut up. Really, seriously, like, you're wrong. The last completion of my academic background is at Harvard, and I studied cross-border capital there under Forrest Reinhardt, who's one of the most brilliant minds in the world. And that was just simply to understand how current accounts and money moves internationally. And then that is how we built the background of how liquidity moves through systems. So my background is macroeconomics at the Hopkins level, a lot of focus on fiscal and monetary policy. Purdue taught me a lot about the micro level. My MBA in finance was heavily built around insider buying, and then Harvard's Harvard. And my wife will not let me go back and get my PhD as much as I want to. Just saying. She won't let me. She said that I had to ensure that my daughter's education prioritizes everything else. And I am in full agreement with that. But if some university out there in the spectrum would like to write me a letter in which they offer me full ride, hey, I'm interested. Just saying. All right. I am a huge nerd, Peter. Deal with it, bud. Deal with it. I love academia. I love to study. I love to read. I love to figure out how the hell this world works. And we go from there. All right. So we see the SPY bouncing at that 662.67 level. We have the 3-minute chart. And this is your line in the sand, right? If you're going to trade it now. Stay in the money at the 662 level. And maybe we get $1 or $2. But you keep your line in the sand right back at that adjusted 60-minute mark, the 3-minute 20 adjusted EMA, and you go from there. That's all it is. You're trading what is right in front of you. And do I know if this market is going to head higher in the next 15 minutes? Nope, I don't. What I'm willing to do, though, is lose $10 to make 100. You have that adjusted moving average. You have a line in the sand right here, 662.50. We're under it. Take a step back, wait it out, see if we push this line. See if we push this line, and then trade around that. That's what trading is. It's all about understanding that line in the sand. All right. What's Jeff saying? Truckee. Truckee, Illinois. Truckee, California. Not only did my boss live in Truckee, he lived on the land where they found the Donner family. I'm not going to tell that story, but you want to look that up. And he goes, yeah, come check this out. I was like, this is a terrible story, my friend. I don't need to know that at all. Ugh. The Donners. And not just that. Here's the other thing. The Donners stayed. They stayed in that area. What are these people doing? No rest for the wicked. All right, let's talk about tomorrow. We got a couple things going on right now. Obviously, the expectation is that the Fed is going to cut interest rates again in October. This is the stock I want you to pay attention to tomorrow. That's KB Home, KBH. This is going to be one of the most important earnings reports that nobody talks about. KBH is a consumer cyclical stock. It is a cheap stock, by the way. This is the problem. The problem with the housing sector is the expectation is that rate cuts are going to be massively positive for the housing sector. People don't understand how the rates actually work. The Fed's fund rate has 0% impact on 30-year mortgages. Nothing. It's a totally unrelated number. Stop acting like it. From a value metric, this stock is dirt freaking cheap, but it is a reminder that it is dirt freaking cheap because of the current economic conditions. This stock is trading under 8 EV to EBITDA. Now, I'm not a huge fan of EV to EBITDA because depreciation and amortization are tax law. I like EV to EBIT, but that's going to end up somewhere in that 8 to 9 range. It's trading for less than EV to sales of 1. It's trading under its price to revenue, 0.63. Price to earnings, 8.2. By every account of basic logic back to Benjamin Graham, KBH is a generational buying opportunity. And yet, 9% float, and it's getting its teeth kicked in, and it's a short. I continue to remind you, when it comes to these names, when it comes to the narrative, stop thinking about economics. Stop thinking that you're smarter than everybody else and simply watch the 2 lines on your screen right now. Is that orange line, that 8-day EMA, crossing positive on that 20? And if so, buy. And if it is not, get the hell out of the way. Because momentum right now, interestingly enough, despite the fact that everybody thinks that housing is going to go through the roof, it's already happened, everybody. The market front ran this rate cut. The market has front run the move another 25 basis points in October, another 25 in December. And now people are taking profits as we break under these key moving averages. This is one of the hardest things to learn about financial markets. Front running. Not front running in a negative perspective, but front running in that this move already happened. So you got Barron's out there a week and a half ago. You got Fox and you got CNBC. And you have all these minds going, oh, wow, interest rate cuts are going to be so beneficial for housing. No, they're not. Look at this. Look at the chart. Look at it break down. You have to learn this. It's mandatory because there's no shortage of people that I've talked to in the last 2 weeks since that rate cut happened going, oh my gosh, what a great time to buy housing stocks. You're out of your mind. The move already happened. It's been a 20% move since June. And remember, the purpose of a market is to sell. It is to buy for $1 and sell for $2. And you have a negative crossover right now on that 820 EMA. Momentum is bearish on housing. And it's going to defy your expectations. Now, we have a new housing report on the schedule coming up. We have the MBA Mortgage Applications Index. Anything to the downside on KBH, the whole thing's going to go. Doesn't mean I'm going to short it. It means that I'm not trying to trade it to the upside. I'm watching these key moving averages. That's it. What else we got? Well, you got Thor. I don't know what the hell these people do. What does Thor do? Thor. Imagine naming your company Thor. And then like giving speeches and optimistic recreational vehicles, same thing. But I thought interest rate cuts were going to be positive for consumer cyclical stocks. No. The purpose of the market is to sell. Do you see it? But they cut rates. That's positive. No. Nope. Short the 820. They're going to report. We'll see what happens. One of these stocks is going to go up 20%, and the other stock's going to go down 40%. The focus again remains around the fact that markets are still digesting the recent rate cut. There's still a lot of stress around hiring. There's still a lot of stress around the broader economy. We are borrowing 7% to print 3% growth. And people go, what? But they cut rates. No. This is the easiest thing in the world. Let's just do it this way. Go George Costanza on it. Do the opposite. Just do the opposite. If Barron's tells you, well, cutting interest rates is going to be very bullish for housing stocks, again, the move already happened. It's already evident in the chart. It's momentum driven. It's already happened. The move already happened. Do you not think that these people want to sell you these stocks? The purpose of the market is to sell. They want to sell you this shit. And remember, I don't cuss unless I mean it. This is a dog shit company. Half these names are horrible names. 24 times earnings on recreational vehicles. Do you think that people are clamoring to go out and buy Thor Industries? No. Money is tight. Interest rates continuing to remain elevated, by the way, from a historical perspective back to 2008. But on top of that, the idea right now that, I don't know, we want to buy this consumer recreational vehicle company. Okay, go on. Give me this pitch. Sounds good. No, because again, as I just showed you, look at the default rates, look at the repo rates, look at what's happening in the consumer cyclical side. People are parking their cars down the block right now so that the repo man doesn't show up. And if you think that ain't it, wait till what comes next. Because next is homes. It's coming. It's going to take a little while, but it's coming. It's not going to be 08 bad, but it's not going to be good. Consumers are behind. K-shaped recoveries have continued to only benefit a very small segment of society while the rest of Americans are behind. And that's not a political statement. That's just an up and down. I don't give a shit about left and right. I only care about what's up and down. And every single recovery since '08 has been a K-shaped recovery that has benefited the equity class at the expense of the middle class. It's not a political statement. It's just truth. You can see it in the numbers. And you can see it in the equities. Because right now, when you look at names like KBH, when you look at the XHB, when you look at a chart like this, that recovery out of April, that's institutions dumping. That's the confidence right now in home builders. There's no more lemon left to squeeze. The shorts are coming in on housing right now. The shorts are coming in on recreationals. They're coming in on consumer cyclicals. They're showing up, and it's quietly happening. Nobody sees it. Very few people see it. Aside from Jeffrey Bierman. Jeffrey Bierman's on top of this the whole time, hasn't he? So that's what he does. He's the best at shorting. Sometimes I see you focusing on the 2050 EMA and other times 820. What's the different scenarios you like to use on the different EMAs? So very good question. Particularly, I like to go long on the 820 and I like to go short on the 2050 because, again, I'm looking for short-term momentum to the upside with the 8 and the 20 and to the downside when that thing moves the other direction. What I like to do is I like to trade from the 20 to the 50 to the downside. So let me give you a hypothetical here. What I look for is a very simple rule. I look for that 8 in the orange and that black 20. I look for that push above that 20-day EMA, 8 rolling with it. And that 8 becomes my stop, right? I buy at the 20, I sell at the 8. But when I'm going to the downside, when I'm looking for momentum to reverse, what I specifically look for is to buy a put at the 20 and sell at the 50 because the 50 is such an important broader momentum resistance line. That's where institutions stop defending. That's where algos stop defending. And right now, as you can see, XHB holding its own right now. KBH gets blown out tomorrow, we got a problem. But as you can see, tapping that line here to here, $3, $4, that type of move, that's what I'm looking for. And we're going to see if this recovers or not. So then what's going to happen with a company like KBH, if we have taken our losses off the table, is I'm going to look for this 8 to do this, sweep up, come under the 20-day, and then once it crosses back over, then I'm going to be back in long if that happens. If it doesn't, I'm going to just kind of hang out because this is kind of in no man's land. If this stock breaks under its 50-day, the rest of the consumer cyclical residential construction stocks will go with it. This is a critical earnings announcement tomorrow. I would love to live in my van. You ever have that fantasy? We're like, I'm just going to go out on the open road, live out in the middle of Utah, have one of those little camper things that you can pull behind. That'd be nice. But that would be very lonely. Oh, well. It was a beautiful dream. All right, let's keep going through this. Let me look and see what other questions we have. Jeffrey Bierman was providing some commentary on Truckee, Illinois, Truckee, California at 7:15. Peter Schroeder saying, we almost rated the telecom in Truckee, California. They wanted an investment grade. We were like, hell no. I have no idea what you're talking about. Why not study how to be a barber? Have you seen my hair? Do you think that would be a good idea? Based on this, would you trust me? Look at, come on. Would you trust a guy with this haircut to cut your hair? Knock it off, Slick Cobra. 1 hour, 4 slopes. Good, 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 good. Peter Schroeder making fun of me for being a nerd. We know, no big deal. Tim, we're good, we're good, we're good. Did I hear they are cutting rates again tomorrow? That's impossible. No. What you want to look at is cmegroup.com/market/interest rate/CME Fed Watch tool. And that will give you the October 29th meeting. 92% probability. And here's the thing. The last time that the Federal Reserve cut interest rates and it wasn't at a meeting, I want to say that was 07, but I'm going to find out right now for you. March 2020, the Fed made an unscheduled emergency rate cut on March 3rd and March 15th. 1998, during the Russian Asian financial crises and the collapse of long-term capital management, where the Fed rates outside regular scheduled meeting. To cut outside of meetings is a huge problem. So be aware of that. We are not looking for a meeting, intra-meeting cut. We are looking for them to remain on time. Now, interestingly enough, for this October meeting, they are not pricing in the possibility of a 50 basis point cut. They're pricing in an 8%. We stay where we are. And they're pricing in a 25 basis point cut at 91%. Then into December, you see the additional move on that 77% side. I'm just going to say it now. They're way behind. And it's all theater anyway. It doesn't matter. Who cares? Why are we spending so much time talking about half this stuff? We do it because it's theater. It's WWE. It's the NFL. Right? This morning, I went to the Ravens game last night. That's why I'm a little sluggish today. That said, I didn't go to sleep until 1:30. Took a while to get home. But here's the thing. Ravens played a football game last night. They played the Detroit Lions. I don't care. I'm not a Ravens fan. But I went and we had a good time and we sat in our seats, and we've had the seats since we got them when the stadium opened, and we're never letting those seats go because they're legitimately on the 50-yard line on the aisle. Pretty good. I rarely go to Ravens games. I don't like live football, but I saw the machine for what it was. I got home, I went to bed, I got up, did our morning show, went and had lunch, went to the gym, swam, did everything I did. And all today was, from Pat McGahee to Stephen A. Smith to Fox Business, Fox News, everything around it. Do we overreact to the Ravens loss? What do we do? Oh my gosh, should we fire John Harbaugh? And you know what? That conversation that they had today, they're going to forget they did it tomorrow. Nobody cares. It's content. It's noise. And that's why I remind you time and time again, half this shit does not matter. It doesn't matter. It's noise. It's meant to distract you. It's meant to try to make you make knee-jerk reaction trades. And the reality is you're the exit liquidity. 99% of the time, somebody wants to sell you that option. Somebody wants to sell you that stock. And my job is to give you the high conviction and the idea that the trade that we're about to do is totally different than anything else you're seeing. That it's backed by mathematics, that it's backed by strong shareholder investing leverage, and the capacity to inform you on a regular basis that you do need to be patient. I'm not trying to go against the thesis of what we do. Everybody wants to trade every single day. I have no problem with that. But I want you to just recognize that I'm in the background. I'm in the background going, now's the time to do this. And it might come every 2 weeks. It might come every month. It might come every 6 months. It might be one of those once a year opportunities where the insiders line up and the pivot comes. And then all of a sudden you buy NVIDIA at 90 and it's at 180 6 months later. That is what I'm trying to separate from you, from all of this. I don't want this to be about noise. I want this to be about the opportunities that you get that are once every couple of months, once every couple of days. And if you want to trade high probability, very simple to do. If you allow the noise to overtake you, then you actually miss the fact that a football game last night, right? A basic football game. Lamar Jackson is probably, if not in the top 10 all-time greatest athletes in the NFL. It can't be debated. But here's the thing. He's extremely volatile. He will make one of the greatest plays you've ever seen in your lifetime, and then 3 minutes later, fumble the ball and kick it behind him 20 yards and lose 20 yards on fourth down and cost the team the game. You know who has more Super Bowls than Lamar Jackson? Joe Flacco, Trent Dilfer, game managers. That's the difference. These guys understood the rules of the game. They didn't fuck up. Sorry for cursing. I apologize. That's the point. They didn't mess up. They didn't make mental mistakes because they were rash. And the question is, who do you want to be? Do you want to be Lamar? Or do you want to be Trent Dilfer? Well, it's boring to be Trent Dilfer. It's very boring to be Trent Dilfer. Sorry for cursing. I apologize. The point that I'm making right now is that you have to be accountable to yourself, be accountable to your trades, be accountable to everything that you are doing, and not put yourself into a position to make the mistakes that you're constantly not just second guessing yourself, but also everyone on television right now, because that's what they want to do, is second guessing one of the greatest athletes possibly in the history of the sport. The point that I'm trying to make, the thing that I'm trying to articulate very simply, is the idea that you don't put yourself into a position to fail. You do what is necessary in every single trade that you make. Every single trade that you make. Whether you're buying Nike, I have no idea what Nike is doing right now. $71. I don't even have to look at the chart, but I can tell if I just look out into December and it's something that I want to own, that if I like this stock, well, then I can sell the $57 put and I can buy the 55. And what does that do? It puts me into a position to succeed because I want to own the stock and I want to make 14% and I want to have a high probability of profit and I'm willing to put up $220 to make 30. And that's it. What do you want to own? What are the things you own that you legitimately not, oh, I have to buy this crazy Riot stock or any of these cryptocurrency names just for the purposes of owning them. Don't worry about that. Think about the stuff you want to own. John Deere. Okay. McDonald's. I just wrote about McDonald's, right? McDonald's is about to absolutely destroy its competition. It's going to destroy their competition. How are they going to do that? Well, I'll tell you. Very simple. Very simple. McDonald's is so good at what they do. They're so good at what they do. And people will look at me and go, wow, no, 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 no. Let me make my argument, okay? McDonald's has multiple times engaged in very vivid and wild price wars with their competition. Seriously. I was telling the story the other day about It's Always Sunny in Philadelphia. There's a scene in the show where Danny DeVito goes to Mac, whose real name is Ronald McDonald on the show, and he says, "You need to keep painting my chair." And Mac is painting his chair gold with spray paint. And finally, Mac says, "Frank, nobody's stupid enough to think that your chair was dipped in gold. Why am I helping you?" And Frank replies, "Because I'm manipulating you. That's the way I get people to do the things that I want." Max says, "Really? That's awesome. How did you do that?" And Frank replied, "Because if you make my chair look nice, I will tell you." And Max smiles enthusiastically and says, "Deal." See how easy that was? The American public is about to get absolutely manipulated on McDonald's in a way that I'm making a trade. Okay? Fox Business wrote an article the other day about how McDonald's is now bringing back their extra value meals to bring back budget conscious consumers. Cool. It's the first time they've done this since 2019. And they brought it back, and Burger King, IHOP, Jack in the Box, Wendy's, everybody is panicking because they have to match with their own value meals. Now you have to understand McDonald's. What makes McDonald's? McDonald's, a one, menu innovation, two, real estate, three, it's a franchise model. They are not paying for any of these losses that they are about to incur. The losses will be assumed at the franchise and the Coca-Cola level. That's it. Possibly whoever is their marketer around chicken. I want you to understand, I used to work in Washington. I used to work in corporate marketing. I used to work in lobbying. It's all about language. McDonald's does not cut prices. McDonald's brings value back to families. McDonald's does not subsidize losses. They invest in communities. McDonald's does not manipulate. They listen to customers. Every single word is focus grouped. Every single word is tested. Every campaign is designed to make you feel like McDonald's is doing you a favor by letting you spend money at their locations. Four things that McDonald's does better than anybody. They don't pay the discount. The franchisees in Coca-Cola will pay for the subsidization of a new $5 menu. Hands down, easy, golden archer strategy. They will control the narrative. The term extra value sounds better than panic pricing. Leo Burnett out in Chicago that does a lot of their advertising work, they're working overtime right now. They bind customers to the brand. They get people in the door for $5 and then they keep them there for 15 into perpetuity. And they own the real estate. They lease all of that land to their franchisees. So every single time that the competitor cuts prices, every single time that the franchisee has to cut those prices, they don't lose their rent check. The genius is not in the price. The genius is in making people think that the price is genius. McDonald's did this back in 2002. After the 9/11 recession, they cut prices, they slashed prices, and once they dominated again, the stock went down 75% to up 300% in a very short period of time. In 2015, they introduced the all-day breakfast menu that destroyed the spirit of everyone in the breakfast industry. And then after they took market share, they got rid of the program in 2020. In 2019, they engaged in what was called the chicken wars. Interestingly enough, 20 fast food companies added chicken to their menus over the next 2 years. And then what happened? Interestingly enough, they were so dominant that the average McDonald's franchise sold 262 chicken sandwiches a day in 2021. Everything starts with a crisis. The $5 menu is not the product. Americans' fast food habit is the product. The consumer data is the product. The belief that McDonald's gives a damn about value is the product. And I joked about this. I said, watch what's going to happen in the next couple of weeks. This is so obvious. It's so obvious what's about to occur. McDonald's is going to probably have new heartwarming commercials about bringing families together. I could write this commercial in my sleep, and I'll tell you exactly what it would be. I would have a father who is overworked and he doesn't pay enough attention to his family, and a daughter who is studying for her SATs or writing her college applications, and they need a break. So they go to McDonald's. And she smiles and she eats a fry just like she was when she was a kid. And he smiles knowing that she's all grown up and she's on her way to college. And the reason that this type of stuff works is because it's about what matters in life. It just so happens that that moment that matters in life happened while you were sharing a $14 value meal. This is marketing 101. And this is how they win. And this is why they're so damn good at what they do. So I look at this chart and I say to myself, McDonald's is about to engage in a price war. Bring it on. They're going to destroy everyone in the process. And by the way, extremely high capital efficient company, extremely good at what they're doing, extremely good at delivering value to shareholders consistently. Look at the EMA 20 over the duration of the monthly chart. It just keeps going up. What do I want to own? What do I want to own McDonald's for? Well, pretty simple. I'm going to go out to January. I'm not going to December. I'm not going to November. I'm going to get past the period right now where we are engaged and worried about a potential sell-off into the end of the year due to profit taking. This is very simple. What you want to do is just get down to a level where you're comfortable buying the stock. And if we go out to January, what we see is something as simplistic as a 10% move to the downside. Buying the writing the 270 and buying the 265. What does that deliver? Well, instead of buying the stock, right? Instead of buying the stock, and getting a yield that really isn't that attractive, right? 2.3%. I can look to be able to buy the stock at 269.43 by selling a spread. I'm putting up $443 to make 57. My annualized returns at 40%. I have a 12.9% max return on risk and a probability of profit at 80%. And I'm telling you right now, when it comes to this company, nobody messes with them. They are going to eat their competition's lunch around this. They're going to create social media campaigns about everyday value. They're going to get influencers to discover what incredible deals you can get at McDonald's. Even if you don't like the food, who cares? My single second largest stock is Altria. I don't smoke. I don't care. Besides, the GLP-1s are going to help anyway. The reality is this: McDonald's is a highly capital efficient company that is very, very good at extracting value from the American consumer. And I can make a decision. I can either say, I want to own this, or I can go the other direction. And if you feel ethically unclean about it, you don't have to do this trade. But this trade will teach you how to approach ideas at the macro level, at the headline level, at the fundamentals level, and at the technical levels. And if you want to wait a little while, see if we get back above that EMA, pay very close attention to that 8-day EMA, right? Let's add that in and let's see what happens. As you can see, right there at that level. Down here, everybody. Down here at these lows of July, down here at those lows at the beginning of the year. We can even go back to that level, go back to that 285 level if you wanted to. 285, 280 to the 275. What does that present? Different math, more favorable to the investor. 81%, 15.4% max return on risk. And the willingness to buy the stock. McDonald's is one of the great American businesses. Doesn't mean that I have to like the food. I usually only buy the food once a month. They're going to focus on the super users. My daughter hates McDonald's. I find that fascinating. She's a Chick-fil-A lady. But the point that I'm making is that these are different ways to trade. These are different ways to focus on what your opportunities are. And if you look at the numbers here, as you can see, 80% probability of profit, 22.5% max return on risk, 408 to make 992, and you are willing to buy the stock at the 280 level. You don't just have to chase the momentum. And if you're waiting for the momentum, well, that's going to be very obvious. You're looking for that positive swing on that 8-day on top of that 20. And as you can see, we've had some nice moves in the past. Profit taking seems to have happened. We went to 320. We pulled back to 300. Now we're looking for positive momentum. And rather than trying to chase the momentum to the upside, what we're doing in this situation is we're just focusing on a high probability of profit. All right. What if I can't afford to buy that much stock? Any good question. Okay, so what you're doing with this trade then is you want to go to option profit calculator. You want to put that in. And what you're going to do is you're going to monitor this. Look at, here's where the stock is at 300. If the stock were to fall to 290 tomorrow, you can buy it back and you can lose 55 bucks, right? If the stock pulls back, what you're doing in this situation is that you're trying to make 22%. But my recommendation is you're willing to lose 10. You're willing to lose $1 for every $2 you're trying to make. And based on this matrix, right, you're monitoring and managing that position. So if you can't afford that much stock and it falls, as you can see, one contract, if you were to buy this back October 9th, and the stock was at 291, assuming no change in implied volatility, you would lose $48. You would just buy it back. I hope that answers your question. Should we construe the McDonald's move to the extra value meal as a precursor to a recession or a financial crisis? No. And I joked about this, and I'm going to wrap it up on this note. I said in an article that if McDonald's resorted to the marketing of late night infomercials, that's when you would actually panic. So in that situation, you would say a Big Mac meal is usually $19.99, but use your Affirm Buy Now Later card and you can get this meal for $8.99, 60% discount. But wait, that's more. Cut off that car in front of you and you'll get direct access to McDonald's next menu innovation before anybody else. You'll also get exclusive access to the McRib for $1 off the next time that pork futures fall into backwardation. Now, act now. There's only 50 Big Mac spots remaining. Don't think, just buy. That is an adaptation of the great John Carpenter's They Live, one of my favorite films of all time. And it's a reminder that we have to just recognize we get to pat ourselves on the back. We see how the whole system works. We joke about it. We have a good time thinking about it. But the reality is that we have to take a step back every now and then and just understand the consumer culture. People want to buy things. They always want to. Buying things makes people feel good. I have an entire closet full of baseball cards. I have not gotten anything good out of it. I've bought so many baseball cards that just are going to sit there forever. But it's the hope and the optimism. This is the time. Same thing with stocks, same thing with everything else. It fulfills our behavioral need. And that's a good thing. Beats fighting everybody over meat. Talk to you guys tomorrow.